Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Hey, Collin, welcome to the show.
Thank you. Thanks for having me.
Man, it's great. It's great. I love having someone with your skill set on because it usually is something that will bring a unique perspective to this industry. You know, what we've heard a lot lately about insurance is what they've called, I guess, what maybe you guys call it, and hopefully you can confirm this, a hardening of the market. Does that sound about right?
That sounds about right. We've been saying it for about 3 years now. So
that's a long time.
Yeah.
Can you give us a frame for us first off, just the listeners have an idea of who you are. Frame for us who you are, what you do, and then maybe we can dig into some more specifics.
Yeah. So Collin Chlebak, based in Kansas City. I work for Virtus Insurance. We've got offices across the country. Chicago, Denver, Fort Collins, Dallas, Austin, Arizona, and hopefully pretty soon in St. Louis. So we've got offices across the country. I lead our real estate practice. We have found a niche and an expertise, deep industry focus in habitational and multifamily assets, middle market in particular. So owners and operators from 1,000 units to 10,000 units. And what we do is with the market hardening, we try to be problem solvers, analytical thinkers, and really outside the box problem solvers. So that's us kind of in a nutshell. We insure to the tune of about 350,000 units across the country. Probably write business. We can write business in all 50 states. Nobody's asked us to place anything in Alaska or Hawaii yet, but we can do it if need be. We've kind of built our entire firm with different industry verticals, right? So we kind of stay in our lane. We are not, I don't want to be picking up calls or phone calls or answering emails or asking people to talk about insurance and manufacturing or gas stations or trucking or something like that. But if it's a head in a bed, as we say, whether it be apartments, student, senior, or even a little bit of hospitality, a head in a bed, we're your guys. We're your team.
Gotcha. That's interesting. Very cool. All right, great. Now that we kind of have that framed on who you are and what you guys do, define market hardening for us.
Yeah. So the market has hardened continuously, like I said, for the past 3-4 years. To give you a little context of what that means, it comes down to the profitability of the insurance carriers. And I know that probably none of your listeners really care about the profitability about insurance carriers. Neither do I. They make plenty of money. But where it comes into your business is how they underwrite and evaluate the rates that they'll give for you and for your listeners on their real estate deals, right? So a little context, from 1980 to about 2016, average claims, catastrophic claims averaged about $19 billion annually. 17, we had Harvey, Irma, and Maria. Then we had Michael and Florence. Then we've had wildfires. We've had floods. We've had all these things. And there has been a huge uptick in U.S. catastrophes, right, to the tune of about $66 billion. And so in the past 3 years, carriers have paid out 3 times as much as they had been paying out. And so you really kind of saw the hardening start, like I said, 17. I think that the industry points to that Harvey, Irma, and Maria, that fall storm. And I think it was August of 17 there, that was the true catalyst. But, you had stuff in the Midwest, the hail belt that, carriers were paying out claims and we were seeing upticks, right? Prior to that, we were seeing deductibles. We would have 10 carriers, you have a portfolio of 1,000 to 8,000 units, and you could package everything together. And carriers, we'd have 10 carriers lined up ready to buy the business. And, that is not the case anymore. They're pushing rates, they're pushing terms, and deductibles have gone from, flat $25K in wind hail to 2, 3. In Denver and Dallas, Fort Worth, we've seen 4 and 5%. So it's, you're pushing more exposure back onto the insureds.
That's interesting. So they're moving away from a deductible as a dollar amount and moving into deductibles as percentages.
That's right. Yeah, that has been the trend in geographic footprints where wind hail exposure has been the primary, right? What I think is real interesting about that is that you see some carriers, and I think at some point it will change, and the prices will get so inflated that somebody will come in and say, well, I'll undercut that and I'll buy that and take that risk. It hasn't really happened yet. We're expecting that and hopeful of that. But what you're seeing, right, is that carriers are saying, look, Denver, from Denver, Colorado, Fort Collins, down to the Springs, your Dallas, Fort Worth, my backyard, Kansas City, Oklahoma City, Tulsa, you're seeing carriers, they know that there's going to be wind hail, right? It's just a matter of how bad it's going to be. And the population density is gotten so deep in those big metros of Denver and Dallas, Fort Worth, that carriers are going to pay something out. They actually, we're seeing this kind of trend where it's less risky to insure something in the coast, right? In a tier 1, a Houston compared to a Dallas, because, Harveys, though they're much more catastrophic, but they only happen once every 10 years or so, as opposed to the annual barrage of your Dallas Fort Worth. And I'm from Dallas Fort Worth originally, so I hate to give DFW a bad name, but from an insurance perspective, underwriting perspective, they're sure taking their share of the brunt right now.
Other than controlling the weather, what are some things we can do proactively to help, both bring down costs? I mean, I'm going to ask for I'm going to ask for everything. Bring down cost, retain quality policies. Because I think correct me if I'm wrong. And again, I'm not an insurance agent. I don't have any insurance licenses, but I would guess one of two things is going to happen. Either prices are going to skyrocket and you're going to retain great coverage, or you're going to see coverages that we don't understand getting pulled from the line. So exclusions start getting popped into policies and rates decrease. And you have an unsuspecting buyer maybe, taking on risk they didn't know about. Again, going back to your comment of, am I wrong on that analysis or? No,
I think by and large, you're right. And I think by and large, that is the $1 million question of how do we control the exposure and control the cost at the same time. Right.
Right.
It's tough. I'll tell you, it's not easy. But we have been successful in doing it. And, it's different from every owner, every operator has got a different risk tolerance. Right. And so I view insurance, if you got a lender on the property, it's necessary, right? It's required.
Sure.
But how you define your risk tolerance and how I define mine, or how, my client next door or whatnot, everybody's got a different opinion. Right. And so we don't view it as our job to sell you the most amount of insurance or the least amount of insurance. Our job is to help you identify where your exposure is and then create a spectrum of that risk, right? From, the lowest deductible to the highest that, you can play in per your lender requirements. And then we show you where the cost differences are in the coverage and the deductibles and all the different terms, so that you can make a transparent, educated business decision when it comes to that, right? At the easiest level, right? You can either increase your variable cost and deductible, right? To compress your fixed cost of premium. Or you can do the exact opposite, right? If you're afraid that you're going to have some losses, and you want to say, look, I don't want to ever have to write a check larger than $25, $50, $100,000, whatever that deductible is. And you might be okay paying a little bit more premium on the front end to control that. But that is the real thing. And it's what other techniques can be used, right? So I talk about master insurance programs, economies of scale, packaging multiple assets together, right, to create economies of scale to kind of create some leverage in the market, in the insurance market. Certainly, 5 years ago, that was the trick, right? And when you've got a softer market and people lined up to buy business from an insurance carrier perspective, that's it. What we have found is that, we just went through a renewal with a client that has 9,000 units, just about $2 billion of total insured value. And the economies of scale at $2 billion of value just didn't win out, right? We chopped it up into smaller tranches. And so that's what you've got to be versatile, right? You got to say, okay, well, this asset is section 42 and it's got a different operating cash flow than our luxury class A stuff, or it doesn't have the reserves, and you can't increase rents to make up for the increased operating expenses, right? So there's different strategies. There's different carriers who like different exposures, whether it be construction of frame versus joisted masonry, or student versus market rate, or again, affordable versus market rate. And so there's all these different things and different appetites. It's our job as the broker to know what carriers have those appetites, and then to learn as much as we can about the assets so we can spin them positively and market them in a way that reflects the best, that will give you the best premium options to review, right? And so there is that. Another thing that we've really started talking a lot over the past 2 years is renter's insurance. And can you, as an owner, dictate that your tenants have renter's insurance? It's going to be better for you. Carriers are going to like it. But then there's some strategic things that you can do about how you place that coverage, right? So if you have renter's insurance in place and you're covered on your tenant's renter's insurance for the first $100,000 in damage, then is it necessary to have a $10,000 or $25,000 deductible? Maybe take the cost break of bumping that deductible up to $100K. And you're kind of insulated from that added exposure. Many times there's some ways to generate some revenue from renter's insurance as well. And, there's three main buckets of it. It's your technology vendors, your Yardies, Real Pages, and so forth. Usually the easiest to administer, but usually, rule of thumb, I think, is, probably the owners see about 20% of the profit of the premium generated, or 20% profit on the premium generated. You've got kind of some unique renter's insurance programs. We have one here at Virtus that we have open market, where the owners can participate a little bit without participating in the risk. And then there's the captive component where, in the renter's insurance programs, specialty market, let's call it 50% of the premium generated. And then you can take it a step further and kind of self-insure that in your own captive. And then you're participating in the risk, but have the opportunity to generate about 80% revenue of premium collected. And so it's, and we've got partners that we roll out and clients that we do that for. It just, again, is dependent upon risk tolerance. So a lot of different things you can do to help, address it. But it's got to be a coordinated effort, and you got to have a broker and a quarterback who I think you trust and has the intellectual capital to merge all these pieces together in one succinct plan.
Right. Yeah, that's interesting. So, having renter insurance, you touched on having a MIP, which I guess you call it a master insurance plan.
Yeah.
Not even
master
sure.
Insurance program.
Your master insurance program. Can you define that real quick for us?
Yeah. So when you look at a portfolio and maybe you've got an owner with 2,500 units and let's just say that's 10 250 unit deals, right? You can approach it a couple different ways. You can place, your lenders are going to require property, general liability, and umbrella coverage at each location. If you have flood or you're in California or the Pacific Northwest, or you might need quake. Some lenders would require it if you're on one of the fault lines there, right?
Sure.
But it's 3 basic coverages, and you can either buy that on a per location basis, right, for each individual asset separately, or you can buy it, combine all of those properties, all 2,500 units, all 10 assets, and put them on one property, one general liability, and one umbrella, so that, which ideally has less administration. You have 3 policies instead of 30
Right.
In that scenario. And so what I was saying is that over the years, that plan has always made the most sense until the market started hardening so drastically. And you might, what's good about that is if you've got, assets in Florida and Arizona, well, Florida insurance for Florida assets are going to be much more expensive than Arizona. And so you can maybe compress the cost of Florida and then on the back side of it, reallocate, right? So that you're kind of Arizona's subsidizing the investments of Florida, but then everybody is paying an overall reduced rate, right?
Sure.
As the market has continued to harden, that we've just seen that strategy hasn't played out, and we have actually, I'm afraid I'm going to start getting the reputation of the master insurance program killer or something, right? The Grim Reaper type thing, because we just keep breaking them up because they don't make sense anymore.
Right. I got you. That's interesting, and I wonder if that is just because. Well, I don't even know. I could speculate on that, but I'm not going to waste our time. That's as to the why.
I just think that carriers, they look at it on a macro perspective, and then they look at it on a micro perspective as well. And if they're not winning in Florida or Texas or Colorado, then they're going to say, well, we're not going to write there, and we're not going to give credit, even though we like the stuff, maybe in Ohio or Michigan or Illinois, right? Like They just, it's a carrier by carrier, and so your broker has to have the expertise of knowing what markets are hot where.
Right. No, that's interesting. Very cool. So what are some things, give us maybe 3 things that a current owner, let's say I have a portfolio right now, rates keep rising on me. I haven't had claims, but yet every year I go to renewal and I go, my gosh, my rates are now going up with everybody else, because you're subsidizing the losses on everybody else's properties. Mm-hmm. What are some things that we can do proactively to help kind of mitigate some of those risk of price increases?
Yeah, I always say, give me a call. No, I always say
it's a great thing to do.
I always say that you should have a second opinion, right? And there are strategies and things that you can do, right? But the market does, a broker doesn't set the market, sure. Right? So I think you should. I always tell, whether you hire me or you hire somebody else, I would always suggest working with one broker who you trust, who's got expertise.
Right.
Buying insurance is a little bit more convoluted than any other buying scenario out there. And if I go to market and another guy goes to market, we end up blocking each other out. It's the first person to market. And so the only way to create competition isn't broker to broker, it's carrier to carrier. Right. And so working with somebody who understands that and can sit down, learn about your portfolio, and sit down and say, okay, what we do is we do just that. We sit down, we say, okay, let's take a look at it. Let's see what options we can do. We run through all the different things, and then we build a list of goals that we can achieve, and then hold ourselves accountable to go achieve the goals that we've set out. So I think working with an expert is the top thing. Being realistic on expectations is another huge thing. And then I think, lastly, if you're looking at deals and trying to get into building a portfolio or something, it's you getting insurance involved early. What we've seen happen as the market has, the real estate market has, in multifamily perspectives, has gotten just so competitive that people are selling deals, and they're selling deals for reasons, right? So they're not selling something that doesn't have any headaches, right? There's a reason why they're purging it from and maybe they've gotten their returns and it's time to time out of it. But, we're seeing stuff with loss history, right? We're seeing stuff that needs CapEx, right? And what the insurance market has said is like, they don't want to be the CapEx budget for people, right? And so if they look at it and the roofs are, 30 years old, it's going to hurt the insurance placement that you're able to get on a new deal, right? If it's got a history of fires, and every year there's a fire, what has the owner done, or what are you going to do in your plan to create it? So it's, the truth is that unfortunately, with the market hardening, people are paying probably twice as much as they did when they pinned out some of these deals, 4 and 5 years ago. And so there are strategies that can be deployed, but you got to be realistic as well, right? And so the earlier you get insurance, your trusted broker involved, I think the better off you're going to be.
Right. No, that's great advice. I think the three things you mentioned there was, compare carrier to carrier, not broker to broker. I think that was your first one. Second one was get realistic. I mean, that's I like that. That's shooting straight, man. Like, just set your expectations. And then the third one was get involved early. So I think the loss history and the CapEx things, if there are, a lot of things that have not been, if there's deferred maintenance, it's going to cost you, I think is what
nobody likes surprises, right? I don't, if you're trying to close a multi-million-dollar deal and you've got operating penciled in at $300 a door, and it's the best you can do is $400 a door. You want to know that earlier before your money goes hard, right?
Well, for sure.
I mean,
for sure.
That's gonna dramatically affect some things. So
And I think finding out those loss history items earlier may even give you negotiation leverage.
Yeah. Oh,
I mean,
100%.
Hey man, you didn't bother to tell us that 2 years ago you guys had a $700,000 claim. Thanks. So by the way, we're going to come down on price because it's going to cost me more in insurance.
That's right. For our clients, right, that we work with, we like to be involved in that acquisition process, right? So we want indications, indicative, what if they have a master program or something, so that they can underwrite to. But as soon as that PSA is signed, right, the first thing we say is request copies of loss runs, right? Now, does that give you the ability as the buyer to kind of re-leverage renegotiate some of the terms of the deal? Potentially, but at least you're going into the deal eyes wide open, as opposed to being surprised by something in the later rounds.
Right. Collin, let's jump into the final four here. If you were giving, or what is one piece of advice you would give to somebody as they, I guess as it pertains to insurance, what's one piece of advice you'd give?
I would say, like I said, it's buying commercial insurance, right, is a convoluted process. So working with either trying to understand the market as it works is important, and working with someone you trust who displays expertise is, I think, probably the biggest thing.
Right. No, that's great. What's one thing you're doing to stay on top of your game?
It's different now, right? Before, this time last year, we were flying around. I would be in 2 different cities a week talking with owners. We've kind of changed our game, and it's allowed us to get out and talk to more people, but we're trying to speak with as many people as we can, right? We've kind of changed our process internally, because in the insurance world, many times you have salespeople and service people, and kind of two parallel paths. What we saw was that the client, there was too much getting lost in the transition. And that's just how the industry has worked for years and years. We didn't create it. And so we have created a new role in all of our verticals, where we have kind of this strategic risk consultant who is in charge of marketing, who all they're doing is worried about placing and marketing deals, so that there is more of a succinct transition between sales to service and renewals and so forth. We're talking with carriers. I didn't go to London this past year because of COVID, but typically we're going over there. We're meeting with markets, and we're just trying to live and breathe multifamily and insurance at the same time.
Right. No, that's great. That's great. It's good to have an expert in our corner. When it comes to giving back, what's one thing you're doing to make the world a better place?
Yeah. So we always, at Virtus, we partner with nonprofits. Last year, we did a cool thing here in Kansas City where we're building houses for veterans community project. One of my clients has a nonprofit resident relief fund, and this past month, every federal holiday comes up, and we try to figure out what we can do. So for Martin Luther King Day, this past month, a couple of weeks ago, we partnered with the Harvesters here in Kansas City, and had a goal to raise a couple $1,000 worth of food that translates into hundreds of meals for families in need in Kansas City. So we try to give back and partner strategically in the different communities we play in.
That's cool. That's very cool. Collin, if our listeners want to get in touch with you, how do we do that?
Yeah. So my contact information is on our website, virtusinsurance.com. I'm on LinkedIn, and I believe all my contact information is out there. Please feel free to post it and share it. Call me, email me, LinkedIn me, and, we'd love to have a conversation.
That's awesome. Collin, thanks so much for your time. Certainly appreciate it.
Sam, thank you so much. I appreciate it. Honored to be on here.